The Union Budget for FY26-27 is here.
आज भारत की विकास यात्रा का एक महत्वपूर्ण पड़ाव है.
India will continue to take confident steps towards Viksit Bharat.
Now, given the previous budget's monumental tax cuts, hopes were already low from this one, at least on the personal taxation front. But thinking that this budget has nothing substantial would be a mistake, for it does have some important provisions that you must be aware of. Now, while there were no income tax cuts, there are crucial changes in taxation. And if you're an investor, the announcements in this budget will help you plan your investments for the coming year. Now, in this video, we will distill the most important provisions of this budget for you. Now, this video is divided into two parts. In the first part, we will discuss the budget provisions that impact you as an investor. And in the second part, we will take a look at the key budget provisions from an economic angle. Now, this video belongs to our playlist on budget coverage. For a recap of previous budget provisions and to watch our budget related videos, you can check it out. The link is in the description. Alright, let's start with the budget provisions that impact you as an investor. For investors, the first key budget provision is how buybacks will be taxed. From the next financial year, buybacks for all types of shareholders will be taxed as capital gains. This means a 12.5% tax on long-term gains subject to an exemption of 1.25 lakh in a financial year and a 20% tax on short-term gains. This is a major relief for minority shareholders as the Union Budget for FY25 made buyback proceeds taxable as deemed dividends in the hands of shareholders. It meant that the entire amount you received was taxable. So someone in the highest tax bracket would have to pay up to 30% in taxes. And to add to this would be the extra headache of setting off the cost of acquisition of shares. Now, we discussed this in an earlier video. For details, you can watch it. The link is in the description. However, promoters will have to pay an additional buyback tax. For corporate promoters, the effective tax rate will be 22%. For non-corporate promoters, the effective tax rate will be 30%. Now, the next key change is the reduction in TCS rates. TCS stands for tax collected at source. It is not a tax outgo but an amount withheld at the point of sale of specified goods or services. You can adjust your TCS later against your outstanding tax at the time of filing your returns. Now, TCS on the sale of overseas tour package programs has been reduced from the current 5% and 20% to just 2%, irrespective of the amounts involved. Similarly, the TCS rates for pursuing education and for medical purposes under the Liberalized Remittance Scheme or LRS have been cut from the current 5% to 2%. For education funded through loans from specified financial institutions, TCS remains at 0% irrespective of the amount. However, if you're sending money abroad for investment purposes, the current TCS remains 20% on amounts exceeding 10 lakh rupees. Up to 10 lakh rupees, there'll be no TCS. The third key change is the increase in the STT or Securities Transaction Tax on futures and options. As the name suggests, STT or Securities Transaction Tax is a tax levied on purchase and sale of specified securities traded on recognized stock exchanges in India. STT on futures is proposed to be increased from 0.02% to 0.05%. On the other hand, for options, the STT is proposed to be increased to 0.15% on options premium and exercise of options from the earlier 0.1% and 0.125% respectively. Now, this has been done with an aim to curb the retail participation in derivative segment. This appears to be in line with SEBI findings that over 90% of traders make a loss in the F&O market. However, this can significantly affect your returns from funds that use futures and options, as transaction costs rise for mutual funds as well. Some of these funds include arbitrage and equity savings funds. Now, the next important change is regarding the taxation of sovereign gold bonds. Until now, sovereign gold bonds have enjoyed tax exemption if held until maturity. It didn't matter whether you were the original owner or bought them on stock exchanges. As long as you held them until maturity, you didn't have to pay tax. The Budget 26-27 has changed this now. The budget says that to avail of this exemption, a buyer must have purchased the bond at the time of its original issue and held it until maturity. What this means is that you buy a sovereign gold bond from the secondary market and hold it until maturity, you will no longer benefit from tax exemption on the gains. In this case, you will have to pay capital gains tax. Now, in the past year, gold prices have risen by over 100%. The government has discontinued issuing SGBs. So, they have been in demand from investors who want to benefit from the rising gold prices. The government probably wants to tax investors who trade SGBs for profit. The next important budget provision is around the foreign asset disclosure schemes for small taxpayers. Now, to address the practical issues faced by small taxpayers, a one-time 6-month foreign asset disclosure scheme will be introduced to require disclosures of income or assets below a certain threshold. Now, this scheme would be applicable for two categories of taxpayers. One, those who did not disclose their overseas income or assets. And two, those who disclose their overseas income and or paid due tax but could not declare the asset acquired. For category 1, the limit of undisclosed income or assets is proposed to be up to 1 crores. They need to pay 30% of the fair market value of assets or 30% of undisclosed income as tax and 30% as additional income tax in lieu of penalty and would thereby get immunity from prosecution. For category 2, asset value is proposed to be up to 5 crores. Here, immunity from both penalty and prosecution will be available with a payment of a fee of 1 lakh rupee. Next, there are several provisions on ease of living and ease of doing business. Individual Indian residents outside India or PROIs will be permitted to invest in equity instruments of listed Indian companies under the Portfolio Investment Scheme. Second, to make it easier for taxpayers holding securities across multiple companies, depositories will be able to accept Form 15G or Form 15H from investor and submit it directly to relevant companies. Now, Forms 15G and 15H are self-declaration forms issued by the Income Tax Department. These allow eligible individuals to request non-deduction of tax deducted at source or TDS on interest income and other specified income sources. Third, the time available for revising returns is proposed to be extended from 31st December to up to 31st March with payment of a nominal fee. Fourth, taxpayers will be allowed to update their returns even after reassessment proceedings have been initiated at an additional 10% tax rate over and above the rate applicable for the relevant year. Fifth, honest taxpayers willing to settle disputes will now be able to close cases by paying an additional amount in lieu of a penalty. And these are not all. There are many other provisions to make compliance easier. Now, this slew of measures is a big positive that makes the budget stand out. And finally, there is the implementation of the Income Tax Act 2025. In the previous budget, a comprehensive review of the Income Tax Act 1961 was announced. The Finance Minister said that this has been completed in record time and that the new act will come into effect from 1st April 2026. The simplified tax rules and forms will be notified shortly so that taxpayers have adequate time to understand them. The Finance Minister said that the new forms have been designed that ordinary citizens can comply without much difficulty. Now, there is one more change that they have made which makes compliance easy. Let's talk about it now. Currently, if a person buys immovable property from a non-resident, the buyer must obtain a TAN to deduct tax at source. This creates an unnecessary compliance burden for the buyer as he would need a TAN for a single transaction. Now, to reduce compliance burden, Budget 2026 has proposed that TAN will no longer be required for such transactions. The amendment will take effect from October 1st. Now, while the government has made compliance easy, it has also put provisions in case you don't comply, and one of these is around cryptos. The budget has proposed levying penalties if taxpayers either don't disclose cryptocurrency they hold or report it incorrectly in line with the new Income Tax Act, which is scheduled to come into effect from 1st April. Alright, so this brings us to the second part of the video of budget and economy. The FM called the Union Budget for FY27 driven by Yuva Shakti, as many of its provisions are inspired by the ideas of young leaders. Since this is the first budget prepared in Kartavya Bhavan, it is inspired by 3 Kartavyas. The first Kartavya is to accelerate and sustain economic growth. This will be achieved by enhancing productivity and competitiveness. The second aspiration is to fulfill the aspirations of India's people. Building people's capacity is the means to achieve the same. And finally, the third Kartavya is the vision of Sabka Saath Sabka Vikas. It is achieved by ensuring meaningful participation by all communities, regions and sectors. Alright, now let's see the fiscal consolidation goals of the government. Fiscal consolidation refers to government's policies aimed at bringing its spending in line with its revenue. The government has set itself the target of reaching a debt to GDP ratio of 50% plus minus 1% by 2030-31 as compared to the debt to GDP ratio of 56.1% in the revised estimates for FY26. The budget estimates for FY27 stands for 55.6%. For FY27, the fiscal deficit is estimated to be 4.3% of GDP as compared to 4.4% in FY26. Next, let's take a look at some of the key schemes announced in the budget to boost manufacturing. The first scheme is the Indian Semiconductor Mission or ISM 2.0. After ISM 1.0, ISM 2.0 will be launched to produce equipment and materials, design full-stack Indian IP, and fortify supply chains. The second scheme is Biopharma Shakti. It is meant to develop India as a global biopharma manufacturing hub. The scheme has an outlay of 10,000 crores over the next 5 years. The third initiative is the establishment of rare earth corridors to promote mining, processing, research, and manufacturing of rare earth permanent magnets. Next, a scheme will be launched to support states in establishing 3 dedicated chemical parks. This will help reduce import dependency. The fifth scheme is one for container manufacturing with an outlay of 10,000 crores over the 5-year period. The goal is to establish a globally competitive container manufacturing ecosystem. Next, the outlay for the already operational electronic components manufacturing scheme is proposed to be increased to 40,000 crores from the current outlay of about 23,000 crores. Then there is a scheme to revive 200 legacy industrial clusters to improve their cost competitiveness and efficiency. Apart from these, there are several other schemes meant to boost manufacturing. Not just this, a slew of tax reforms for manufacturing have been announced. Now, all of these speak volumes about the government's emphasis on manufacturing. The budget also seeks to renew the emphasis on the services sector. The budget seeks to establish a high-powered education to employment and enterprise standing committee to recommend measures that focus on the services sector as a core driver of Viksit Bharat. The idea is to make India a global leader in services with a 10% global share by 2047. The second initiative to boost the services sector is to upgrade and establish new institutions for allied health professionals or AHPs. Then comes a scheme to support states in establishing 5 regional medical hubs in partnership with the private sector. The underlying idea is to promote India as a hub for medical tourism services. To support India's AVGC industry, that is animation, visual effects, gaming and comics industry, AVGC content creator labs will be set up in 15,000 secondary schools and 500 colleges. In the education space, 5 university townships will be created in the vicinity of major industrial and logistics corridors. Now, apart from these, there are a number of measures across areas like sports, tourism, medicine, healthcare, and etc. Attractive tax reforms have also been announced to boost the services sector, especially the IT sector. Now, there are important announcements in the budget for other sectors too. In the financial sector, a high-level committee for Viksit Bharat will be set up to align the sector with India's next phase of growth. Now, in power to achieve scale and improve efficiency in public sector NBFCs, as a first step, it is proposed to restructure the Power Finance Corporation or PFC and Rural Electrification Corporation or REC. In the infrastructure sector, from an estimated allocation of 11.2 lakh crores in FY26 budget, the allocation has been increased to 12.2 lakh crore to continue the momentum. Now, to accelerate recycling of significant real estate assets of CPSEs, dedicated REITs will be set up. Now, there are several other key provisions to support infra, which makes it another key sector to watch out from an investment standpoint. Like infra, urbanization had also received its fair attention. The establishment of 7 high-speed rail corridors is a major initiative here. Now, improving farmers' income via productivity gains in agriculture and allied sectors appears to be a step in the right direction too. Now, all these provisions will likely play a key role in India's mission to become a developed country by 2047. So, while the market's reaction was rather cold to the budget does contain many far-reaching provisions whose impact will be only revealed with time. So, what's your view of the budget? How would you rate it on a scale of 1 to 10? 10 being the best and 1 being the worst. Do let us know in the comment section. So this was a rather quick video and for obvious reasons. Over the next couple of days, we will dive deeper into budget provisions and try to bring you a more insightful one. So stay tuned. And that's all I had for you today. I'll see you soon. Until then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.